Okay, moving on to the disposition of accounts and notes receivable. This is probably my favorite area of accounting. I spent years working in this area of accounting, and I really enjoy it. Unfortunately, it basically just gets us like a side note in the back of a accounts receivable chapter. If it was up to me, it would have its whole own chapter, and we would throw out some of the other chapters. For instance, LIFO, retail LIFO inventory methods that we'll be covering in like 3 weeks. But we have a whole chapter on that. We don't have a whole chapter on this, so I get to tack it on to the back of accounts receivable. So, disposition of accounts receivable. Some of the reasons I like this: one, it's a big banking issue, and I worked in banking for years, audited banks for years, so I dealt with it a lot. This is also an area that causes a lot of complexity and issues. So, if we were to back up and look through, I would say, most of your major accounting and financial scandals over the last 20 years or something, this pops up over and over and over again. I won't say it's always there, but this is something that comes up over and over again. Do you know what caused essentially the downfall of Enron? The accounting standards associated with the disposition of receivables. Or basically the sale of financial assets, which is what this falls under. That's what caused Enron. Enron basically sold a bunch of really risky, poorly performing assets to another related party that they treated as not a related party, but they still had a continuing interest in those assets. And once that became evident, suddenly the balance sheet of Enron exploded with a bunch of garbage, and they had to recognize massive losses. So you could say this area of accounting is essentially what caused the downfall of Enron. If you looked into the financial crisis, we'll take a company like Lehman Brothers, who manipulated its financial statements by shifting financial assets, high-risk financial assets, off of their books right at the end of the quarter so they could report a nice clean balance sheet, and then with the agreement they'd buy them all back right after the quarter ended. And Lehman ended up going bankrupt. Lehman Brothers at the time, it was a massive investment bank in the country. And the fact that it basically disappeared in a day was devastating and cannot be understated, the impact of that on our financial system, on accounting in general. So this idea of the ability to, when can you dispose of assets, what counts as a disposition of an asset, when is it sold versus just loaned out to somebody, is really important, and it constantly keeps coming back up and back up and back up. And every time we have a scandal, they issue new standards that hopefully fix it and resolve it and don't allow it to happen again. And then we end up with another scandal. So this is something that keeps coming up again. For scandals, it's very complex. And because of all that, I kind of enjoy it. So here's what we're going to talk about. This is a very boiled down version. We don't get a lot of the glitz and glamour in this case, but there is still a little bit of it in here. Disposition of accounts and notes receivable. So owners may choose to transfer accounts and notes receivable to another company for cash. The idea is, I have a bunch of receivables, I want cash, so I'm going to basically sell them or somehow transfer them to somebody else, get the cash, and then I can use that cash in my operations. In banking, this happens all the time. So the idea is you have a subset of banks and financial institutions that do a great job of originating loans. Think of like Chase has a massive credit card business, right? They can originate credit cards all the time, and they do. Tons of credit cards get issued by Chase. Well, Chase is really good at issuing credit cards, but the value to Chase is not in holding on to the credit card receivable for 60 days until the customer pays. That's like blah. Chase does not make its money because it's holding on to these receivables. It makes its money because it found the customer, got them a credit card, and is now basically able to generate this constant stream of loans through these credit cards. That's great money for Chase. That's how they make their money. They don't want money stuck in outstanding balances on credit cards for 60 to 200 days. So what they do is they get it to where they get the customers start using their credit cards. So the Chase has these credit card receivables. They then package them all up and sell them to other people in the market. We do that for credit cards. Mortgages are done the same way. No bank wants to hold a 30-year fixed rate piece of debt or a liability to you for a house. That's massive amount of risk to the bank. And the bank provides its value by basically finding customers, not holding on to this mortgage liability for 30 years. That's like ridiculous. So what they do is they find other people, say investors or pension accounts or whoever, who actually like the idea of having an investment. They can invest in mortgages. Like, what's better than the mortgage on the American home? Well, that's what people thought prior to 2008. Anyway, right? So you have these mortgage brokers now who are in the business of originating mortgages. And then as soon as they originate them, they package them all up into a security and they sell them off into the market to people who want mortgages as an investment. Whereas these people are in the business not of owning an investment in mortgages. The mortgage brokers are in the business of originating mortgages. So it splits it out. The investors are happy, the brokers are happy. The brokers have more money to do more mortgages, and investors have their investment that they were looking for. That's how this works. So this idea that we're transferring these financial assets to other companies to receive cash, it happens all the time. It is the bedrock of much of our financial transaction system that we have in this country in terms of debt. So pretty much almost all debt is somehow transferred off. Now, companies themselves can take their accounts receivable and transfer them off as well. It is far less common. It is typically only done by companies who are very high credit risks. Otherwise, the bank would just loan them money and take the receivable as collateral, as opposed to actually taking possession of the receivable. There's a little bit of a difference there. It's the difference between if you buy a car, it's the difference of, like, if you're a good credit risk, you can get a bank loan for the car. Right? Like, whatever, I got a bank loan, the bank took the car as collateral, the bank has no expectation that they're actually going to have to come repossess the car. So, and I get a pretty decent rate. Now, that's if you're a good credit risk. Now, if you're a bad credit risk, you're not going to be able to go through a typical bank, because they're going to be like, hey, we're in the business of loaning money, not repossessing cars. But there are plenty of car dealers and individuals out there who are in the business of repossessing cars. So they will give just about anybody a car loan, assuming that they think they can get the car back and make money on it if you don't pay. So I banked a guy who did this in Chicago. It was, boy, the stories he had of repossessing. But I mean, he made a business out of essentially repossessing cars. He would sell people cars. They're high risk. They wouldn't have been able essentially to buy a car through normal channels. This guy, in one sense, he provided a very valuable service. People who could not buy a car through the high credit system in our country has this option. It's like one step above a loan shark. He's not going to break your knees, but he will come and take your car at 2:00 in the morning. So, right. He provided a very valuable service, but his rates were really high. And if you didn't pay, he was fully ready to drive up and pull the car out of your driveway at 2:00 in the morning. And he did that routinely. So that's more the scenario we're in if companies are actually selling their receivables, because they're no longer a normal credit risk, they're a high credit risk. But it does happen. When I was in banking, typically, so I was in just a normal commercial bank. We had pretty high credit customers, i.e. not high risk, so stable customer base. I had probably a couple of clients while I was there who went from being good credit risk to being bad credit risk, and we would transition them to a different financial institution who would do much more, would basically do what's called factoring of receivables. So they would basically buy their receivables from them, and then the financial institution would collect on those receivables instead of the customer collecting, or the company collecting on their receivables. So that's kind of the scenarios that we have when we're dealing with this transferring of accounts and notes receivable. What we have right now in terms of GAAP. Now, as I said, this has changed a lot. After every crisis, it changes again because someone found a loophole in the system. What we've got right now is pretty good. There's probably definitely some loopholes there, but they've done a pretty decent job of trying to patch up some of the worst of the ones that were out there, especially during the worst ones in 2005, 6, 7, 8 timeframes. So we transfer receivables. The first question, does it meet 3 conditions? Does the transferred asset, is it isolated from the transferor? That's the person getting rid of it. So they cannot, it has to be isolated from them. So typically that it's what used to be referred to as like bankruptcy remote. I don't know if that's how it's referred to now, but this idea that if it has to be isolated from them, which means even in bankruptcy, the creditors can't come and get it. So it's isolated from them. So that's the first thing. Second, transferee has the right to pledge or sell the asset. That means the person you're selling it to has the right to then sell it and do whatever they want with it. Well, that kind of makes sense. And lastly, the transferor does not maintain control through a repurchase agreement. Hello, Lehman Brothers. So if I sell you something and it's isolated from me and you can pledge it or sell it, but I can buy it back from you when I want to, then did I actually sell it to you? Well, no, because if I wanted to change something or if I wanted whatever, I would just say I'm executing my option to purchase this back from you, and you would have to give it to me because that's part of our agreement. So those are the 3 things that have to be in place for a sale to occur. So if you meet those 3 conditions, then yes, you get to recognize a sale. And the next question, so we'll get to the next question in a second. If no, you don't get to recognize a sale, and what you actually have is just a secured borrowing, i.e., you put those assets up as collateral for cash. You didn't sell the assets, you just borrowed money and put those assets up as collateral. The difference is, under secured borrowing, those assets stay on your books. And under a sale, the assets leave your books. That's the big difference. And there's the reason we keep going round and round with the standard is that financial institutions need to be able to get these assets off their books when they do make a sale. So there's a lot of lobbying to get sale treatment or sale accounting in place and maintained for these assets. And that's why we still have this, and why there are, like, not everything gets recorded as a secured borrowing, even though there's some things you would look at and you'd probably be like, it's kind of borderline. Well, that's what there's accountants out there trying to figure out how to do. So if it is a sale, then the question is there continuing involvement? If there is continuing involvement, you still record it as a sale. However, you have to recognize the value of that continuing involvement. So you can reduce the receivable, so the receivable goes away because it's recorded as a sale, and you recognize an asset obtained and liabilities incurred, and you record a gain or loss. So that's if there is continuing involvement. If there is no continuing involvement, you reduce the receivable and you record the gain or loss, and that's it. So that's the big difference within sale, is whether there's continuing involvement in the assets. That often happens when banks sell financial assets. So if I'm an investor and I want to, let's say I want to invest in mortgages. Well, I want to invest in mortgages, but I have no desire to send out statements every month to people who have a mortgage. That just doesn't sound like any fun. So banks will perform what's called servicing, which means they handle, say, mailing out statements, collecting payments every month, setting up escrow accounts, all the other things that are associated with doing this. They do that, that's called servicing, but that's continuing involvement. So they need to recognize essentially the value of that continuing involvement at the time of sale. But they still do get to recognize it as a sale, even though they're still involved in the assets. So basically, in the sale of receivables, we have the customer and the company. The company has a receivable from the customer. The company is going to take that receivable and they are going to transfer it or sell it to a factor. A factor is someone who gives them money, money for or buys the receivable from them. And then the customer actually makes payment to the factor. That's why it is a sale. So that's the general structure. Now, there are 2 things we need to worry about. two things we need to consideration: whether that sale to the factor is with or without recourse. If it is without recourse, the purchaser assumes the risk of collection. So the factor assumes all the risk of collection. So if they buy $100,000 and only $50,000 of it is collectible, well, they only get $50,000. There's nothing they can do. That is, the transfer is an outright sale receivable, and the seller records a loss on the sale. That's how that's handled. If it is a sale with recourse, that means that the factor can go back to the seller for non-payment. So as you can imagine, sales without recourse have much bigger discounts than sales with recourse. A sale with recourse, there's really just an interest charge being assessed because there's no risk. The risk of non-collection lies with both the customer and the company, whereas a sale without recourse, the credit risk lies entirely with the customer. And remember, the factorer did not vet these customers, the company did. So they don't necessarily know the credit worthiness of the customers who are paying the case. So those are our two conditions. In a case when we have a sale receivable without recourse. So let's say we have Crest Textiles. They factor $500,000 of accounts receivable with Commercial Factors, Inc. on a without recourse basis. Now, Commercial Factors assesses a finance charge of 3% of the amount of the accounts receivable and retains an amount equal to 5% of the accounts receivable for probable adjustments. Crest Textiles and Commercial Factors make the following journal entries. So, Crest Textiles, they received cash of $460,000. That is the $500,000 minus the 3% minus the 5%. So a total minus 8%. So that's how much cash they got. Now they have a receivable from the factor for 25%. That's the 5% that the factor held back for possible future adjustments. That's how the factor protects itself. And then they have a loss on the sale of receivables. That's the 3%, because that's just the cost associated with selling these receivables. And then they reduce their receivables, which is a credit to receivables of $500,000. That's on the company side. Now, on the factorer side, the factorer gets $500,000 of receivables. They owe Crest $25,000. They owe them $5,000 or 5%. Remember, they held that back for possible adjustments. So, but right now there are no adjustments. So they actually still owe that money back to Crest. They get interest revenue of $15,000. That's the 3% finance charge that they're assessing. And they gave cash of $460,000. So those are the two sides without recourse. Now, assuming that they sold it with recourse, on a with recourse basis, and Crest Textiles determines that the recourse obligation has a fair value of $6,000. To determine the loss on the sale of the receivable, Crest Textiles computes the net proceeds of the sale as follows. So it takes cash received, adds back the due from factor, and then they subtract out the recourse liability. So the net proceeds then would be actually $479,000. So the $479,000, we take the $500,000 book value minus the net proceeds of $479,000, which gives us a loss on the sale receivable of $21,000. Again, the $21,000 is both the $15,000, which was the 3% finance charge, and the $6,000 recourse, the cost to the recourse in this case. So both of those combined to give you the loss on the sale when it's sold with recourse. Now, the journal entries for this when it's sold with recourse. So Crest Textiles, they get cash of $460,000. There's the due from factor of $25,000. The loss now is $21,000 instead of just the finance charge. And they're taking out the receivable. And they record a liability for the potential recourse. That means this is the amount that's going to come back that they're going to have to basically pay extra on. So the liability of $6,000. Now, for Commercial Factors, there's accounts receivable of $500,000 that they now have. So they got that. They still owe Crest that $25,000 that they held back. They have interest revenue of $15,000, and they get cash of $460,000. Note, we aren't changing anything other than there's that there's a recourse liability here. Typically that would have gotten, we're assuming that these are different sets of receivables. Otherwise, if there was really $6,000 of collection liability, then commercial factors probably would have built that in the non-recourse setting. So that's if it's treated as a sale. Now, you can also treat it as a secured borrowing. Now, if you treat it as a secured borrowing, it's actually pretty straightforward because there's no assets to take off of your balance sheet. All you're doing is recording a liability. So in this case, you record the cash coming in, so you're not selling assets, you're just borrowing money. So you record cash, you record any finance charge, which is typically an expense, and you record your payable. That's all you do. It's a borrowing with basically kind of an upfront finance charge for this short period of time, which is why it's recorded right as an expense right away, as opposed to over time. And that's because your receivables typically are clearing within, say, 30, 60, 90 days. It's short term again. So in terms of some last presentation analysis of receivables. So presentation of receivables. So we need to segregate the different types of receivables that a company has. So trade and non-trade receivables that we talked about earlier in an earlier lecture video. Those have to get separated in the financial statements. We need to offset receivables with their valuation allowances so that on the balance sheet, we report accounts receivable net of the allowance. That's the amount that gets reported on the balance sheet. That gets offset right there in one line item. We have to figure out, okay, what's our current receivables? What are our long-term receivables? They have to get split out between current assets and long-term assets. Any contingencies that we have on the receivables, for instance, if it's a contingent, any kind of contingent receivable, that needs to be highlighted. A lot of times, if it's a contingency, it's actually not a receivable yet. But if there is and it does qualify as a receivable or as an asset, then we would need to highlight and disclose what the contingency is. And we need to disclose any receivables designated and pledged as collateral, and the nature and credit risk of the receivables, i.e. who are they to and what's our credit risk. So a lot of times for public companies, if their receivables are, I think it's 5% is the cutoff. If they have receivables of, or more than 5% of their receivables or sales are to a specific customer or company, they have to actually specify exactly what that is, because that customer represents a credit risk and a business risk to the company. So that actually has to get disclosed as well. But I think that's an SEC requirement, not necessarily a GAAP requirement itself. So in terms of analysis of receivables, accounts receivable turnover is typically the most common. That's just net sales over the average accounts receivable for the period. And that tells you how many times your receivables are turning over. So it's sales over receivables or net sales over average receivables. And that says, okay, well, if my receipt, let's say I made $1 million of sales for the period and I have $100,000 of receivables on average. Well, that means that I am collecting, that my receivables have turned over 10 times, right? I collected 90%, so my receivables have turned over 10 times. If you were to equate that to how often is, or what's the duration then of your receivables, you would take 365 days divided by 10. So my receivables are, my typical receivables I'm holding for 36.5 days, if it's straight up 10. So that is accounts receivable turnover. That's the most common ratio analysis that's used on receivables. So that wraps up our entire discussion of cash and our discussion of receivables. That was a lot to cover this week. You guys can get through it, and make sure you knock out the questions that I'll provide you. And with that, have a great day. God bless.